Hi, I'm your CFO. Let me tell you something that might shock you. Most small businesses don't fail because their product is terrible. They don't fail because there's no market demand. And they certainly don't fail because the founder isn't working hard enough. They fail because of one thing: cash flow. I'm speaking to you as a CFO who has seen this pattern repeat itself hundreds of times. And I can tell you with absolute certainty, businesses don't die from lack of profit. They die from lack of cash. If you're a business owner, what I'm about to share could save your company. If you're thinking about starting a business, this information is worth more than any business course you'll ever take. Stay with me because we're about to reveal the #1 killer of small businesses, and more importantly, how to avoid it. Here's the first mistake almost every founder makes, and it's a killer. They believe profit means money in the bank. It does not. Let me say that again because this confusion alone has destroyed countless businesses. Profit does not equal cash. Profit is an accounting concept. Cash is a survival requirement. Here's what this looks like in the real world. You can show a profit of $50,000 on your income statement and still be unable to pay next month's rent. You can report 30% growth and still miss payroll. You can look incredibly successful to everyone around you while being financially fragile on the inside. How is this possible? Because revenue is recorded the moment a sale happens. But cash? Cash is only recorded when the money actually hits your bank account. Think about that. If your customers pay you in 30, 60, or 90 days, guess what? Your business is financing them. You're paying your expenses today for money you haven't received yet. And here's the brutal reality. Suppliers don't wait. Employees don't wait. The tax authorities? They definitely don't wait. This timing gap between making a sale and receiving cash is where most businesses start bleeding. Slowly at first, then catastrophically. Now I'm going to tell you something that most entrepreneurs absolutely do not want to hear. Growth can kill your business faster than stagnation. I know that sounds insane. Every business book tells you to grow. Every investor wants growth. But here's what they don't tell you. Every new sale usually requires cash before it generates cash. Think about what you need for each new sale. You need inventory. You need labor. You need marketing spend. You need logistics. You need systems and infrastructure. If each new dollar of revenue requires more cash up front than the last dollar, your growth is unfunded. We call this negative working capital pressure. And here's what it looks like. Sales go up, but cash goes down. From the outside, your business looks successful. You're growing, you're winning. But inside, your bank balance is collapsing. This is one of the most common failure patterns CFOs see. Founders are celebrating growth while finance is seeing the warning signs of an impending disaster. I've watched businesses double their revenue and go bankrupt in the same year. It happens more often than you think. Let's talk about working capital. This is where most small businesses fail silently, without even understanding what hit them. Working capital comes down to 3 things: how fast you collect cash, how fast you pay cash, and how much inventory you're carrying. If your customers pay late, your cash is trapped in receivables. If your inventory sits unsold, your cash is locked on shelves gathering dust. If your suppliers demand early payment, cash leaves your business faster than it enters. This creates what I call a permanent cash squeeze. And when you're in a permanent cash squeeze, the business becomes dependent on owner injections, credit cards, short-term loans, and delayed payments to suppliers. Let me be clear, this is not strategy. This is survival mode. And survival mode is expensive. Interest rates on credit cards and short-term loans will eat your margins alive. Delayed payments destroy supplier relationships. Owner injections drain personal resources. You cannot build a sustainable business in survival mode. You can only delay the inevitable. Here's another brutal truth. Most small businesses operate with no real cash reserve, no buffer, no contingency, no margin for mistakes. They assume next month will always be better. They assume customers will always pay on time. They assume costs will stay predictable. This isn't financial management. This is hope. And hope is not a strategy. One delayed customer payment, one unexpected tax assessment, one equipment failure, one bad month. That's all it takes to shut the business down. Cash buffers buy you time. Time allows you to make decisions. Decisions save businesses. Until next time, stay cash positive.